In this video, I will explain lease and lease agreements. There are two parties involved in a lease agreement, lessor and lessee. Lessee is the person who uses the asset and pays the lease payments to the lessor. Lessor is the person who initially has the asset and gives it to lessee, and upon an agreement and for a specified period of time. In this lesson, we are going to assume that decision about leasing or purchasing are secondary business the assessments, meaning that we already assume that we are capable of taking a lease. So we are going to analyze whether it is good to take a lease or it is better to purchase the property. So when we lease an asset to use, it is going to require much less capital cost. If we purchase, we have to pay all the capital costs upfront. The purchased property can be depreciated, and but when we lease the property, it's upon the agreement. I will explain later in the lesson that it might not be depreciable. There are many types of lease, but in this lesson I'm going to focus on just two of them, two main types of lease. One is the operating lease and the other is the capital lease. According to an operating lease agreement, lessor is allowed to use the asset for a defined period of time. Lessee is paying the lease payments, operating lease payments to the lessor. These operating lease payments are deductible in full amount from revenue as tax deductions. They work similar to operating costs. In this type of lease, usually the lessor holds the ownership of the assets, but it can be agreed that it can be optional for the lessee to take the ownership, but it is assumed that in the operating lease, the lessor holds the ownership of the asset. And when the lease period is finished, lessee has to return the asset to the lessor. So for the lessor, lessor can depreciate the asset because the asset is being used. Lessor can depreciate the asset according to MACRS method. So the other type of lease is called capital lease. Capital lease is also called financial lease. According to a capital lease agreement, the ownership of the asset is transferred from lessor to lessee upon the lease agreement. So the capital lease is somewhat similar to taking a loan, buying the assets, buy the loan, and then paying the loan installments, paying the loan payments to pay off the loan. So if you are interested to have more information about lease agreements, I'm going to put a link to Financial Accounting Standards Board that includes more information about lease agreements, and you can read more in this page. So here are the differences between the operating lease and the capital lease. In the operating lease or rental agreement, lease payments are deductible in full amount. They can be expensed in full amount from the revenue. The ownership is usually not transferred to the lessee. So depreciation is not allowed for the lessee, again because we are assuming that the ownership stays with the lessor. Depreciation is not allowed for the lessee, but lessor who has the ownership can use the depreciation. For the capital lease or installment loan purchase, the ownership is transferred to the lessee. Lease payments are not deductible in full amount, but the interest portion of lease payments can be deducted from revenue as tax deductions. The lessee can use depreciation as tax deductions because lessee is going to have the ownership of the asset. I will explain this in a bit. Salvage value is applicable for the lessee again because lessee is going to have the ownership of the asset. So let's work on this example and see how the lease calculation works. Assume as a manager you want to decide whether to lease or purchase an asset. The capital cost required for the asset is $200,000. At present time, the salvage value is going to be $60,000. At the end of year 5, the purchased asset is depreciable using the MACRS 5-year half-year convention. If you lease the asset, you need to pay the lease payments of $50,000 from year 1 to year 5. The asset is going to generate the annual revenue of $100,000 from year 1 to year 5. The operating costs from year 1 to year 5 are going to be 20, 25, 30, 35, and $40,000. The tax is going to be 40% and the discount rate is going to be 16%. Here we summarize the information that we have. So let's start with the purchase decision alternatives. We draw the timeline. We start forming our table. We have 5 years. Revenue is $100,000 from year 1 to year 5. Then we add salvage in year 5, $60,000. Then operating cost of 20, 25, 30, 35, and $40,000 from year 1 to year 5. We deduct them from revenue. And then depreciation, we use half year MACRS for 5 years of depreciation. We extract the rates and we multiply them by the value of asset, which was $200,000, the capital cost required to buy the asset. Then we calculate the taxable income. We make a summation over each column. The tax is 40%, so 40% of taxable income. And then we calculate the net income, which we deduct the income tax from the taxable income. Then we add back the depreciation and the capital cost at present time if we purchase the asset. And then we calculate the after-tax cash flow, and in the end we will calculate the NPV for the decision alternative of purchasing the asset. So NPV at 16% discount rate is going to be $20,221. Now let's see how much will be the NPV if we lease the asset. So if we lease the asset, we are going to have the same revenue, $100,000 per year from year 1 to year 5, but there will be no salvage because we as the lessee don't have the ownership of the asset. The operating cost is going to be the same. We add that to the table with a negative sign. The next is going to be the lease payments. So if we use the operating lease, we are allowed to deduct these lease payments in full amount in the year that it is happened. We can deduct them from revenue as tax deductions. So we deduct these as revenue. We deduct the $50,000 per year of lease operating costs from revenue. Again, these lease payments are intuitively similar to operating costs. Then we calculate taxable income, 40% of tax, and then we calculate the net income. Again, because we as the lessee don't own the property, we cannot depreciate. We cannot use the depreciation upon the operating lease agreement. So we calculate the after-tax cash flow. So here we don't need to pay the purchasing costs, and we are not benefiting from the depreciation and the salvage. And then we calculate the NPV of this after-tax cash flow, considering a 16% discount rate, which is going to be $42,180, and we can see this NPV is much higher than the purchasing of the asset, so we can decide to lease this asset and not purchasing it. So I'm going to use a spreadsheet to work on this example quickly. So first, purchasing the asset, the revenue is going to be $100,000 per year. Then we are going to have salvage, which was $60,000 in year 5. Then we are going to have the operating cost, which was minus $20,000 minus $25,000 minus $30,000 minus 35 and minus 40. And then we are going to have the depreciation, for the depreciation. I will go to table A1 MACRS half-year convention in IRS website. These are the rates for 5-year half-year convention. So I will just read them and enter them to the Excel spreadsheet. So I will calculate these here. I will say here. The rate was 20%. So in order to calculate the depreciation, we multiply the capital cost of $200,000 by these rates, and these are the depreciation from present time year 0 to year 5, and we add them to the table with the negative sign. And again, because this is the half year depreciation, it has actually 6 years of depreciation because we move everything 6 months ahead. So we are going to have actually 6 years of depreciation starting from present time. Then we calculate the taxable income. Which is the summation over each column. We apply that to the 5 years. Then we calculate the tax, 40% of the tax, which is going to be 40% of taxable income. I have to consider a negative sign here too. And the net income, which is the summation over these, or we deduct the tax from taxable income. So because I entered the tax with the negative sign, we are just going to make a summation. Then we add back the depreciation, which is going to be this depreciation with a positive sign. So it has a negative sign. I might multiply it by a negative sign. And the capital cost with a negative sign. Which was $200,000. And then we calculate after-tax cash flow, which is the summation over this column. Then we calculate the NPV. So because we have a payment at the present time, we enter that manually, plus using the NPV equation and entering the 16% of discount rate. And we are going to have the NPV of $20,221 for purchasing the asset. So for leasing the asset, I will just write the table here. Lease the asset. So the revenue is going to be the same, so I copy it from up here. We are going to have the operating cost, which is going to be similar. So I will just, these are equal to these numbers. And then we are going to have lease operating payments. Which is going to be $50,000 with a negative sign from year 1 to year 5. Then we calculate the taxable income, which is the summation of this column. Then we calculate the tax, 40% of tax, Then we calculate the net income. And because we don't have anything else here for the lease payments, this net income is going to be equal to after tax cash flow, which is going to be exactly these numbers. And then we calculate the NPV. As we can see here, there is no payments at present time, so I don't need to enter anything manually, or because this is zero, it is going to be zero, so I'll just directly use the NPV function, 16% of discounting rate, and this cash flow. Can conclude that this is investment is going to have better return if we lease the asset instead of purchasing the asset. In the next video, I'm going to explain how we can calculate the capital lease and how we can evaluate a project considering capital lease.